good evening, everybody. Tonight's webinar I find particularly interesting and sometimes a little scary. It's Greenback, and they're going to be talking about their expertise is working with expats like us and how to be a resident and a citizen of the US and what that means in terms of your taxes. So this is I can't tell you how important it is because both my son and my husband are going to be in the room with me because they are so interested and nervous and happy because we all found out the tax situation is a lot better than we thought, but you know, taxes are always very fraught. So we're looking forward to Alan explaining exactly what Greenback does for us. And this is going to be really interesting and incredibly important. So enjoy.
Great. Thanks, Jackie. So Alan will have a presentation for us, and then we'll go straight to a Q&A after the presentation. And the first section will be recorded. And if you prefer to ask any questions after the recording, stick around and you'll be able to do that when we've concluded the recording. Good evening to Larry, Alex, Gail in Canada, Barbara, Amit is here. Good evening in Estoril, already this side here in Portugal. Mark in Lagos. Trevor, good to see you. 20 degrees, balmy 20 degrees in Lisbon today. And Thea from a rainy San Diego. And Sean arriving in April. Great news. Ready to celebrate with the Carnation Revolution 50th anniversary, Sean. Good timing. You're sure to have a good time here in Portugal around that time. Now, let's go over to Alan. From Greenback. Great to see you again, Alan. We haven't spoken for a little while. Things have been changing a little bit tax-wise here in Portugal, so it's great that you're here. And I know that pencils are being sharpened and people are ready to take notes. So over to you. Welcome and thanks for being here.
Okay, hello everyone. Again, I'm Alan Feaster with Greenback, and we're a boutique tax firm that specializes in American expats. We do all federal returns, state returns, anything US related. We also offer consultations. So I've got a presentation here together for you just to walk you through some of the basic information that you definitely need to know and some of the things that can really help reduce or eliminate your tax bill. Okay, so let's just get right into it. So our whole goal here at Greenback is just to make the process as stress-free and easy as possible. If you look at the reviews that we have online, they look actually like they're fake because they're so good. But that's one of the things we really pride ourselves on is just the excellent one-on-one service that we give you. We also offer some very competitive prices. We haven't raised prices in actually 6 years and only recently just raised prices, but by only 2%. So we try hard to give a lot of value here. Here's a little bit of slide. Here's a slide about me, but I'm not really going to go over it. I'd like to just tell you a little bit about all the accountants at Greenback Expat Tax Services. We are all CPAs, enrolled agents, or attorneys that have at least 3 years international experience. So when you work with us, you're going to be in really good hands with some really knowledgeable professionals. Okay, so let me just give a quick overview of the presentation. We already talked a little bit about who we are at Greenback. We're going to talk about some of the expat tax requirements because, you know, the United States tax system is pretty unique and complex. I'm going to go over some of the deadlines and, of course, some of the tax benefits that you can use to reduce or completely eliminate any taxes that you owe to the United States. And then I'm going to talk briefly about what you can do if you haven't filed in a long time or if you haven't filed correctly. And there's a great program for that we can get into, that we can help handle if you find yourself in that situation. Okay, so most countries that you live in require you to file a tax return. But when you're a citizen, of example, of the UK, and you move outside of the United Kingdom, generally, you don't have to worry about filing UK self-assessments, their tax returns. So almost all countries are like that. The US, along with North Korea and Eritrea, I believe, in Africa, a little bit different. They say, hey, if you're a citizen, doesn't matter where you are, It doesn't matter where your income comes from, you're required to file a tax return each and every year if your income is high enough. So that's a surprise to a lot of people. There's a lot of misconceptions out there. A lot of people actually question, about it, legitimately, like, do I really have to file? One thing I say is just open up your passport and look through it. And there's some things usually towards the end that talk about your requirements to file tax returns. And it's just right there. And enforcement's really been picking up over the years. So this is something, you really need to stay in compliant with, because the penalties can be pretty harsh. Okay, so what really determines whether or not you have to file a U.S. tax return is how much income you have. So if your income is low enough, typically you don't have to file at all. And that includes all of your income. That includes wages, salaries, any investment income that you have, if you own a business or a rental property, anything. And in fact, the way the U.S. law is defined is that if they don't say it's not income specifically, then it's considered income. So it's a very broad net. Unfortunately, it's not the same when it comes to deductions and exclusions. They say we have to specifically state what those are, or you can't take an exclusion or a deduction. So let's just jump into this a little bit. But first, let's talk about some of the key forms here that you should know about in the key filing requirements. Okay, the first is the FBAR, or the Foreign Bank Account Report. Okay, now I think that name itself is just a little misleading, because it sounds like you only have to potentially report bank accounts, but that is not the case. It includes any financial account that you have. So yes, it does include bank accounts, but it can include investment accounts, certain retirement or pension accounts, and it can even include certain insurance policies if it has a cash surrender value. Okay, so if you exceed the thresholds that are set, that $10,000 threshold, you're supposed to report all of your accounts, not just the ones that are over 10,000, but all of them. And the general idea that we say is, if you're not sure if you have to report a bank account or other account, just go ahead and report it anyways. The reason being is there's no penalty for reporting too many accounts, but there are penalties for reporting too few. And in fact, the penalties are about $12,500, which is pretty steep, kind of, in my view there. So when do you have to file an FBAR? And this gets a little bit confusing, because the law says it's when the aggregate value of all your foreign financial accounts are over 10,000. So it seems to be a lot of different ways to interpret that. So I like to just give 3 quick examples to help really clarify that. Okay, so let's say you have 2 accounts in Portugal, 2 different bank accounts, that's it. Okay, you look at the highest balance in each account, and you determine, what that is, and you add those values together. So for example, say on June 30th, you had 4,000 US dollars equivalent in one account, 4,000 in the other on the same day. That total is $8,000. It doesn't go over the $10,000 threshold. You don't have to file an F. Okay, let's change the facts a little bit. And let's say, okay, what if you had $5,000 in the first account and 5,000 in the second account as the highest balance? Now you met that $10,000 threshold, and you have to report both accounts on this FBAR, which we can, of course, help you with if you like. Let's change the facts a little bit. And this is what really throws off a lot of people. This last example. Okay, let's say the highest balance in both of your non-US bank accounts are $4,000 on June 30th. So you have $8,000. Okay, that morning, for whatever reason, you get $1,000 transferred into your first account. Maybe it was a bank error. Maybe somebody's giving you some money. Doesn't matter. So now you have $9,000. You don't have to report anything. Now that afternoon, you transfer $1,000 from the first account over to the second account. Now in total, you only have $9,000. But the highest balance in the first account was $5,000, and in the second was $5,000, and now you have to report it. So The rules get a little bit tricky. And again, when in doubt, just go ahead and, just report your accounts because those penalties are really harsh. You don't have to pay any extra fees or taxes to the IRS for filing this. It's just what they call an informational report. But the penalties are, in my mind, ridiculously brutal. Now, there's two other forms that I'd also like to let you know about that can really help save you money. The first is the form 2555. That is for the foreign earned income exclusion. So if you have earned income, which is salary, wages, bonuses, or money that you earn as a self-employed person, you can exclude up to a set amount from your tax return every year, and it's just not taxed. That amount changes every year. And for 2023, that's $120,000. So you could have a salary of $120,000. You still have to file a U.S. tax return, but you won't have to pay any taxes. You get to exclude that entire salary. Now, the other form that's on the slide is the form 1116, or the foreign tax credit. The details and technicalities can get a little bit complicated, but the general idea is easy. If you're paying tax in a foreign country for income that you've earned in that country, be it from rental, from renting a property or running a business, or maybe you're working for a company there, you earn some interest from bank account, whatever. You have income earned from a foreign country and you pay income tax to that country. Whatever you pay, you can use that to reduce your U.S. tax bill. And in countries with higher tax rates than the U.S., that means you can reduce your U.S. tax bill probably all the way down to 0. Okay. And when you need help with these forms, of course, we can help you with that as well, either through preparing your taxes or doing a consultation. So I'm going to just go ahead and skip the slide. I think I talked quite a bit already about FBARs and their importance. But the one thing to remember is that these are not actually part of your U.S. tax return. They don't go to the IRS. They go to FinCEN, or the Financial Crimes Enforcement Network, which is a pretty ominous sounding name. It's just a different department of the Department of Treasury. Okay, there was another law passed that's referred to as FATCA, okay, the Foreign Account Tax Compliance Act, which doesn't really tell you anything. Okay, it's very, very similar to what I discussed about with the FBAR. Okay, in that you have to report all of your financial accounts. There are two slight differences. The first is when do you have to send in this additional report? That's almost the same as an FBAR. When do you have to do that? Well, the thresholds are a lot higher. It depends on your filing status, whether you're married, filing jointly or not, and where you live, in the U.S. or outside of the U.S. If you're outside of the U.S., the simple way to look at this is if you have $3,000 at any time in financial accounts, then you're going to be required to file a U.S. tax return. I mean, you're going to be required to file this report. The other key difference is that includes other things that are not in financial accounts, like banks and brokerages and investment institutions. It includes if you own like a part of a partnership, corporation, or other company. Okay, I'm going to move on here a little bit. I don't know if we'll get to quite all of these slides, but I'll be available to answer any questions that you have now and later. So I talked about at the beginning of a certain income that you needed that will require you to have to file a tax return. That is generally based on a standard deduction. The standard deduction is a fixed amount that's set every year by the IRS. And if you earn less than that, you don't have to file a tax return. So that really depends on your filing status, whether you're single, married, filing jointly, or etc. So if you're single and you earn less than about $2,500, you don't have to file. If you're married filing jointly, you double that amount. And there are two quirks to that. If you're married filing separately, for example, you're married to someone from Portugal or wherever, income of only $5 requires you to file a tax return, which I think is ridiculous, but I don't make the laws. Also, if you own your own company and you earn more than $400, then you're required. Okay, we're going to move on here a little bit. Normally, when you move out of a state, you don't have to continue filing a state income tax return. Some states are a little bit hard to get out of. The only kind of general exception is if you have income from that state. So you have a rental property in California. Well, then you have to report that rental property's income on a California state income tax return. Or you own a small business in New York State. Well, then you have to report that business's income and not only on a New York State tax return. But generally, when you leave, you're pretty much out of their system. A couple of deadlines here to keep in mind. April 15th is the deadline for most people to file their tax returns. But as an expat, you get an additional 2 months. So your deadline is June 15th. If you need more time, you can always file an extension to give you until October 15th to file. Okay, the deadline to file an FBAR, the foreign bank account report, is actually also June 15th, but there's an automatic extension until October 15th. You don't have to do anything. You don't have to fill out, send in anything for this extension. I don't know why they just don't say the deadline is October 15th. They say April 15th with the extension. And if you do have to file that FATCA report, that's included with your tax return on Form 8938. That's due at the same time as your normal tax return. All right. So we're going to talk just real briefly again about some of the benefits you can get for living and working overseas. I'm just going to jump right into that. So as I mentioned before, one of the key things is the foreign earned income exclusion. Okay, and you get to exclude up to $120,000 worth of salary income or self-employment in 2023, as long as you qualify. And for the qualifications are basically you are living indefinitely or permanently overseas, and you're there, for at least 1 calendar year, or you're in a foreign country for at least 330 days out of a rolling 365-day period. So just to kind of simplify that, if you move overseas and you're there for quite a while, at least over a year, you're going to qualify. If you move and come back and move again, maybe not. But for the most part, if you're overseas and working for at least 1 year, you should qualify and you get the benefits for all that time you've been overseas. Okay, the physical presence test, as I mentioned, is a little bit tricky and it's a little bit misunderstood. Most people think you have to be you can't be in the US for 35 days or more from January 1st to December 31st. That's not exactly true. The 35 days or less in the United States is true, but it could be any 12-month rolling period. It could be from February 14th, 2024, all the way to February 13th, 2025, for example. You're allowed to pick and choose. The other way you get this tax benefit is if you're a bona fide resident. Okay, sometimes you have to wait to file your tax return to qualify under this, but basically, if you're living with the intent to stay there indefinitely or permanently, you should qualify. It should be no problem. You get this benefit by filing that tax form 2555. That's part of your U.S. tax return, which is due June 16th. You can extend it out to April 15th if you want as well. Now, if you are renting, not owning a property, but renting a property, you may be able to deduct some of that rental expense under the foreign earned income housing exclusion, which sounds great, but it's not quite so generous. But if you can apply, if you can qualify for it, then why not take the extra deduction? So that is basically for rent. It's for most utilities that you have, or property insurance, things like that. You can see that on that slide. So anything over about $18,000 you can deduct. But if all of these expenses are less than $18,000, and that number will go up a little bit each year, anything less than 18,000, this won't actually help. So this is really geared for a lot of high cost of living places like London or Paris, or Tokyo, etc. But if you can get it, why not? Okay, again here we're discussing the foreign tax credit on this slide. That's another tax benefit for living and working overseas. And remember, that's basically for when you pay tax for income earned in a foreign country, you can use that to reduce your U.S. income tax. Okay, so which benefit that you take, either the foreign earned income exclusion or the tax credit, kind of depends on a few things. But one main thing to keep in mind is that if you're in a high tax country, meaning you have to pay tax to a foreign government, but you can use that to reduce your U.S. tax bill probably to zero. If you're in a high tax country and you have children, you probably want to use the foreign tax credit method to reduce your U.S. income tax. That's because if you have children, you can claim the child tax credit as long as they have a Social Security number, and that could give you a refund, cash back, even though you don't owe any tax to government, a refund of about $2,000 per child. Okay, so which one you choose really kind of depends on your situation. Not only that, but what you might do in the future: go to the United States, maybe move to a country like Dubai that has little or no income tax. So there's a lot of things to consider. So it's always good to maybe have a consultation with us and help kind of figure this stuff out. But I figured I would just give a quick example here of how the foreign tax credit works to help really clarify this for people, because it's not I pay $20,000 to Portugal so I can reduce my U.S. tax bill by $20,000. Not exactly, but let me just give a really clear example here of how this works to help you understand it a little bit better. So whatever the highest tax rate is between the two countries, Portugal and the United States, for example, that's what you're going to pay, that highest tax rate. It's just a question of how it's divided between the two countries. So let's say, for example, the tax rate in Portugal was 30% and the tax rate in the United States was 40%. Okay, so you pay that 30% to Portugal and you use that 30% to reduce your U.S. Income tax due to 10%, and then you pay that 10%. So 30 and 1 is 40. You still pay that highest tax rate. Okay, it's just how it's divided up. But let's reverse that a little bit, because there's a slight nuance here, a very good one. And let's say the tax rate in Portugal was 40%. Again, I'm just making up these numbers for an example. I know it's not that simple. Let's say it's 40% in Portugal and 30% in the United States. Okay, under the foreign tax credit, you pay that 40% to Portugal, right? That 40%, and you reduce your U.S. tax bill to zero. So again, you're still paying 40, but what about that 10% that you didn't use from Portugal to reduce your U.S. income tax? Does that just disappear? Do you lose that? And there's a great provision in the tax law that says no. That 10% that you couldn't use, remember 40% Portugal, 30% US, that 10% you couldn't use, you get to hold on to that and use it for up to 10 years in the future, but as long as it's for foreign taxes paid, right? You can't, if you move back to the United States and live there for the rest of your life, none of that income would be foreign income, so you can't use a foreign tax credit. But that additional, it's called a foreign tax credit carry forward, you can use that for up to 10 years. After 10 years, it expires. So it's a really excellent. Finally, what I'd like to talk about before we go into the Q&A session here is, what do you do if you haven't filed for years, right? Maybe you just didn't know that you had to file U.S. tax returns while living abroad. Many people don't. I get calls about that all the time. Or what if you've been paying a lot of excess taxes that you didn't need to? Or, what if you haven't been filing your FBARs, your FATCA reports, or there's something critical that you didn't do because simply you didn't know about it. And a lot of times it's when somebody sets up a foreign country company outside of the United States, that comes with some additional heavy reporting requirements that there's a lot of penalties for. So there's a couple of things you can do. You could do nothing, which I don't recommend, but you could simply do nothing. You could just file your past tax returns, just file them late, like just and hope the IRS never says anything. But generally, the best option is the Streamlined offshore filing procedures, which is an IRS amnesty program. Okay, to qualify for this program, you have to be in. They look back at the last 3 years, and you have to have been outside the United States for at least 330 days of the year in any one of those years. So it's not, 330 days in a foreign country for each of the 3 years. Just one will get you in. Number two, you have to write a statement explaining your situation and explaining, hey, I just didn't know I had to do all this stuff. Okay. Number three, you have to go back and file 3 years of past tax returns, either returns that weren't filed or returns that weren't filed right, so you have to amend them. And also, if you had to file these FBARs or foreign bank account reports, you have to go back 6 years and file those in any years that you apply. So it's a lot of work. Why would you go through all of that? Two great reasons. Number one, the IRS typically waives all penalties. Some of these penalties, like I discussed with FBARs, they add up super quick. Okay. Number two, if you haven't filed for more than 3 years, say it's been 10, 12 years or whatever, all you have to do is file for those 3 years for your tax returns, 6 for FBARs. All those past years, the IRS just says, don't worry about it. Forget it. It's fine. You don't have to file all of those. Okay. So it's a great program. I get calls and emails about this all the time. I Greenback to a lot of these all the time. And it really helps get people back on their feet and get right with the IRS. It's a fantastic amnesty program to file.
That's good.
So with that, I just kind of want to wrap it up a little bit. Here's some of our contact information. Feel free to reach out to us at any time.
Alan, superb. Thank you very much indeed. And there is a referral link to get to you in the chat tonight. So please use that link. And very good to make reference at the end there. I think that might have been a nice surprise for some people, or nicer, if not nice. Addressing this whole business of filing hesitancy or filing fatigue. It's best to do something about it, isn't it? I think is the point you were making, and the link is there to get in touch with Greenback. So I guess to anyone who's a bit hesitant, it's good to take action. Sticking your head in the sand is not going to help.
No, that's true. In fact, there's been a lot of talk about not renewing passports, and they can specifically do that if they deem that you owe a certain amount of tax, about $54,000. And then if they do deem that you owe any tax, you can't really ever get out of that through bankruptcy or anything. That's
extraordinary, isn't it?
So kind of like to refer to the IRS as almost like the mafia.
Yes, I don't think you're alone in that. I don't think you're alone in that. You said it, not me, however, on this recording.
We're not still recording, are we? No, I know.
But incredible information, thank you. And how amazing that you also point out that the requirements are in the passport that may not get renewed in those worst case scenarios, as you put it there as well. So fantastic information, great presentation, and lots of questions, as you might imagine. So let's get into those straight away if we may there. Rubbing your hands. Excellent. Let's go.
I'm glad to help. A lot of people are so stressed and worried.
Yeah,
and
right.
One of the best parts of my job is that, I really take a lot of that away.
Great.
You may still have to file and do this and that, but at least people know what all the real facts are.
Wonderful, wonderful. And your colleague Shari's working behind the scenes. Thank you, Shari, for doing that. I see you're getting busy with some of the comments already. And we should point out, in the Philippines where you are, it's about 4 in the morning. So thank you so much for being here and working so hard for everybody this evening. Keep up that great work. So we start tonight. When answers come in and people add to the questions, forgive me if it upsets the order of the questions, but the first one I can see is from Laurie. Good evening to you. FATCA is funds/cash, not my US home's value. What do you make of that, Alan?
FATCA is Could you repeat that?
FATCA is to do with funds and cash, not my US home's value.
That is pretty much correct.
Okay.
So this FATCA only has to do with foreign items, just like an FBAR.
Yeah.
So you don't have to report any US-based accounts or anything on these. There are a couple of exceptions of what you don't have to include on a FATCA report, which is Form 8938. Okay, cash doesn't have to be reported. Precious metals, like if you had some gold bars in a safe in your house, and real estate does not need to be included on these FATCA reports. When not filed, the penalty is $10,000 per year. So it's important to get these right. The things that typically do need to be included: foreign bank accounts, foreign investment accounts, most retirement and pension accounts, not all. There's certain things like US Social Security that don't need to be included. And then they call it foreign assets. So these are things that you own that aren't in a financial institution like a bank. Like it could be ownership of a company, like part of a corporation or an LLC company, or even a corporation that, you own the shares or certificates or units, but it's not in a bank. Those definitely need to be included as well. So great question.
Yeah, great question. Great answer too. Thank you, Alan, for that. Mark is asking, if you have bank accounts in the US that exceed $10,000, but accounts in Portugal that are under the 10,000 limit, then I do not have to report them.
That is correct. Now, there is a spot on Schedule B, interest and dividends, where there's two questions: check yes or no. Do you have any foreign accounts? You check yes or no. If you check yes, then it says, are you over that $10,000 threshold? If you check no, you're done. If you check yes, you have to list the countries. And then later you do your FBAR report, which is separate from your income tax return. But again, if it's a US-based account, then it doesn't get reported on an FBAR or a FATCA. It's only the non-US accounts.
Great. Thank you for that. Good question. Thank you, Mark. Thank you, Sherry, as well, for the work you're doing behind the scenes there on these. And to clarify from Vicky, it's $10,000 for the FBAR, not euros. In other words, euros held here in Portugal need to be valued as dollars to compare to the 10,000. Is that correct?
Yes, that's correct. Everything has to be reported to the IRS and FinCEN in US dollars.
Right.
And they publish specific exchange rates that you have to use for these purposes. They're called the BSA, or Bank Secrecy Act exchange rates. So it's not just any exchange rate or the IRS exchange rate or your exchange rate. You have to use a very specific one. I just want to point that out for anyone who wants to
that's useful, isn't it?
do these forms themselves, because they're always wondering what rate do I use.
I imagine it's based on a challenge from somebody who said, I got a really bad rate, but it converts to only $2, weirdly enough. Okay, so it's like the BSA that you're looking out for there. Thank you, Trevor, for this. Good to see you tonight. How does the FATCA know if you are US resident or expat for the limits? The US tax return and the FBAR, from what I have seen, don't have an easy way to identify yourself as an expat.
Well, it doesn't matter if you're an expat or not. It's all about, do you have financial accounts or assets that exceed the limits?
Right. And then the onus is on you to do something about that.
Yeah. So it doesn't matter if you're sitting in the US and you own, you have a bank account for 100,000 pounds at HSBC in London. It's just reporting it. And the idea here is that the government is paranoid Americans abroad are hiding money in offshore accounts and in offshore companies, etc. So that's how they want us to know. And how would they actually get that information from foreign countries? Well, they pretty much already have it. I guess they're just not really using it, or using it in limited ways. There are IGAs, or international government agreements out there, in which either foreign banks report accounts with US owners directly to the IRS, or because of secrecy law, sometimes a foreign bank can't report. So they report it to their government, and then the government reports it to the IRS so that they comply with their local laws.
Okay. I see, Trevor, you got your hand up there. Did you want to jump on, Trevor, and unmute and ask that question or add to it?
Yeah, so the FATCA actually has the different limits, whether or not you reside in the US or if you don't reside. And so, like on our U.S. tax return on an FBAR filing, those don't really matter unless we want to take some part of that. But the fact, like you listed on your slide, shows limits for us living abroad and for a lower limit for us residing in the U.S. And my question was related to how do they know? And does the form actually then show you to prove that you are not a U.S. resident, that you're a foreign resident for the upper limits?
Oh, okay. I understand. I understand. Well, yeah. So which limits apply? The limits, the lower limits where you're living in the United States, or the higher limits, which are about 4 times higher if you're outside of the United States. So which numbers do you go by? Well, you know, you just have to self-report this for the most part, because a lot of people like to use a US address, family, friends, virtual mailbox, so US address as a mail-in address, because the IRS does a horrible job with sending letters out. So a lot of people use that, and they'll have the US address on their US tax return. And unless they're filing, you know, for the foreign earned income exclusion, where they have to report where they live and work outside the United States, or a foreign tax credit, it may not be evident on your tax return that you're actually an expat. So when it comes to basically everything on your US tax return, it's basically self-reporting. So you're supposed to put down everything and all your information that they ask for. You're supposed to keep those records for a number of years in case you're audited. Right? And if you are audited, then you have to basically prove it, all the numbers on your return or whatever they ask about. In which case it could be, hey, everything on your US return said looks like you live in the US, but you didn't report these FATCA accounts. You went by the lower limits, not by the higher ones. Why is that? Well, I've been living in Portugal. I rented an apartment for 3 years, or purchased a place. I have a residency card. All these different things. But hopefully, if you do your tax return right and you're careful, you avoid audits altogether. They're never fun. Does that help answer your question, Trevor?
Yeah, it does. I think because, I mean, again, like you said, we do use a U.S. mailing address because getting stuff from the IRS is a lot quicker to
Yeah.
the mailing service. And my thought was, again, if they ever come back to us on anything, is just go, here's our lease agreement and here's our Portuguese residence. And yeah, we haven't been a residence. We
Yeah,
do use a
exactly. You
mailing
just show them that information. And if anyone out there ever does get a letter from the IRS, it'll always give you a deadline to contact them. And I always recommend you contact them right away. They hate being ignored. Right away, and just say, hey, I just got this letter. I need time to figure it out, or to talk to a CPA or something. Please give me another 30 days to get back to you.
Ah,
And
good
they're
strategy.
generally very nice. They hate to be ignored. But
Okay,
if you
so that
find
will
it out,
stop
you talk to them.
escalation. Yeah, that would,
Yeah, yeah.
yeah, okay, that's very good. That's great advice as well. Thanks for that, Alan. Barbara, is your question related to this part of the oh, okay. Can I come back to you after I've done a few more of these in here? Cheers, Barbara. Thank you for that. Tom, also adding to that particular point of Trevor's there, the IRS would note you used a foreign address on the form 1040. There's also a box there to check that it is a foreign address. And also, I'm guessing the IRS won't accept the excuse that the CTT here in Portugal lost the mail. They've probably heard that one before. Stephanie says, if I worked in Arizona in January through to September, I do not have to file an Arizona state return if I move to Portugal in October. That's a very specific one. Can you help with, Stephanie?
Yeah, absolutely. So
worked in Arizona January through to September.
yeah.
Therefore, do I not have to file in Arizona a state return, that is, if I move to Portugal in October?
Unfortunately, you would be required to file an Arizona tax return. You were there and earning income from January to September.
Yeah.
So you would file a part year or non-resident tax return. It's just one form for part year residents and non-year residents. You would report all your income worldwide from January through September and pay tax to that to Arizona. But starting from September on, all of that income to the end of the year, you're not an Arizona resident anymore. As long as none of that income was earned in Arizona, you don't report and pay tax on that. Going through to the next year, starting January 1st of the following year, you're completely out of the Arizona system. You don't have to worry about filing or paying Arizona taxes anymore.
Okay,
So
thanks
it's
for that,
just that
Alan.
cutoff period
Yeah.
in the year.
Good news and bad news kind of there for Stephanie. Thank you. Loads of questions, so I'll rattle through these if I may. If I have a US Social Security income while permanently living abroad, does that income count as US income or as Portuguese income? That's a good question.
Well, the income is coming from the United States, and it's coming from work that you did while in the United States to build up those Social Security credits. So that would be U.S. sourced income.
Okay.
Now you might have to pay taxes in Portugal for that, right? But generally the way it works is, if it's sourced in one country like the U.S., that's the country that has the first right to tax it.
Yep.
So
Okay.
for foreign tax credit purposes, you'd pay the U.S. tax on that. And then, as a resident of Portugal, you have to pay tax on all of your income. You would calculate how much tax you owe on your Social Security, and you'd use the foreign tax credit for the taxes you paid in the U.S. to reduce your Portuguese tax due. So that's how that general process works. And depending, there might also be tax treaty provisions that you can take. Those in general are not so generous for Americans abroad. They're much better for, non-Americans, U.S. citizens, or green card holders that are in the United States.
Thanks,
If I
Alan.
may speak up here, if you have an NHR, then that suppresses the maximum level of taxation in Portugal. So then you would only have to pay tax in America, I would imagine, because
That I'm not too familiar with.
Yeah, you'd have
I'm
to
not
speak to
familiar with
your
Portuguese.
taxation expert on this side of the water for that, which I'm assuming, Alan, you're dealing strictly with US Expat Tax Services. You don't deal with the finances here on this side of the water.
Yeah, that's correct. But Mark, I do hear that, it is sort of a fixed rate in Portugal. There are some sort of tax benefits.
yeah.
I'm sorry, I don't know that much about it, but definitely maybe speak to someone on that side of it.
And we can definitely help you with that, Mark. So drop a line to admin. Sean, bear with me because I'm going to come back to you. I've got a lot more other questions that I need to get through. And thanks everybody for being patient tonight because there are a lot of questions. And I really appreciate your considered approach and answer and calming influence here, Alan, on these. So we will get through as many of these as possible. Did I understand correctly? Alex says that if I have an official residency in Portugal and live there for 1 full year, then I can stop paying my California state taxes. What paperwork is involved?
Oh, out of all the states, California is the hardest one to break tax residency out of.
Yeah.
Okay. So in general, like I was discussing about the question about when to pay Arizona tax, in general, once you leave, you're out of the system. So you might have that part of the year where you have some tax issues, not the rest for the rest of the year or going on forward. California is pretty tricky. They do a lot of residency audits. So in general, what California said, what most states say is once you leave the state, you break residency and you're done. California takes it a step forward. They say not only do you have to leave, but you have to establish residency in another place. And they really want some good concrete evidence of that. Maybe it doesn't sound like a big deal, but it kind of really is. So they can be pretty aggressive. So what I always recommend for people moving out of California is number one, make sure that final part year tax return is done properly, and that any references that you can remove from California are. Second, cut as many ties as you can with the state. So what they mostly look at is things that they can find easily, right? So do you own property in the state? Yes or no? You can still own property in the state and not be considered a resident, but again, this whether you're a resident or not is subjective, and they're always gearing towards not wanting to let you out of the tax system. So they look at if you have vehicles registered in the state, they look if you have bank accounts there, if you're registered to vote, different things like that. And based on that, they may decide to start a nice little residency audit or not. So I do a lot of consultations every year, specifically how to plan to break residency or what to do. They're pretty aggressive. Anyone else who's out there who's maybe moving from New York State, they're pretty aggressive, especially if you own, lease, or rent any property in the state, specifically New York City.
Very
But
interesting.
in general, to answer your question, you should be out.
So it sounds like a call, Alex, to Greenback, and the link is in the chat tonight for that. Vicky, along with other, I think, disappointed Canadians tonight, you work specifically, as it says on the tin there, US expat taxes. You can't help Canadians, by the sound of it.
We only do US income tax returns. We don't prepare Canadian returns.
Right.
Probably not. But if you have any US tax issues, you have some income or accounts in the US, or you want to do something in the US and you want some tax advice, we can. But Canadians, your government is generally much friendlier to you than our government is to us. Right. So at least in that regard, you're lucky.
Consolation there. And you do have a Canadian tax accountant partner that can be recommended. So that's useful to know as well. Thanks, Sherry, for popping that in the chat. Jeffrey's asking, what are the FATCA form requirements and deadlines? Are they simply filed with 2023 1040 following those filing deadlines? Does that make sense to you, April 15th?
Yes, Jeffrey, exactly. So right. If you're in the US, April 15th, if you're outside the US, June 15th, and you can always file an extension before one of those dates to give you until October 15th. But yes, it's just a form that goes along with your US income tax return, Form 1040.
Okay, but Barbara, thanks, Alan. Barbara, can I call you back on? You wanted to ask earlier on, and it may be connected to what Rebecca's asking. And as Barbara asked, wouldn't that be reported on Form 1116? Barbara, are you there? And do you still want to ask a question?
I am, yes, thanks. And so about the Form 1116, he's saying only foreign earned income gets reported on that. So, for example, if we have a pension in the U.S., it's taxed in the U.S., Portugal is also going to tax it. How do I report that to the U.S., to my taxes? So I owe 10% on it in Portugal. I owe 30% on it in the U.S. It's not foreign earned income.
Well, that's correct. So it's in general, and a treaty might change that position or certain tax laws in Portugal. But in general, for all things, that Form 1116, that's only for foreign earned income, not income earned or, to use tax jargon, sourced in the United States. Okay. So that income that you have, that does come from the United States. So the U.S. generally has the first right to tax it. So you would pay that tax, and then you would claim a foreign tax credit against your Portuguese tax returns, if they allow for that, and whatever rules they have for that as well.
Right. Okay. Does that help, Barbara? So
you would not be filling out the Form 11116 for that U.S. sourced income. Mm-hmm. If Portugal has an equivalent of that form for their individual income tax returns, that's what you would fill out in Portugal to help reduce any Portuguese tax you paid based on the U.S. taxes that you paid.
Okay, thank you. And then we would pay, in that case, you would probably file in the U.S. first.
Yes, that way you know how much tax you owe on that. Mm-hmm. So you know exactly how much tax you can claim on your Portuguese tax return or other tax returns. Now, those are generalities, so please don't hold me to any specifics, because I just do U.S. tax returns. But in general, worldwide, those are how tax credits work.
Okay, thank you for that, Barbara. Thanks. And I think when it starts to get into a sort of deeper dive, it's well worth making that call to Greenback and setting up an appointment, I think. I'm going to stop the recording in about 10 minutes so that the recording isn't too long, but there'll still be a chance for people to ask personal questions as well. Let's go to you, Sean, because I saw a question from you and then it disappeared. I think somebody may have answered it or added to it. Sean, what were you asking?
So it follows up on what was just discussed.
Right.
I had a consultation with a Portuguese accountant who very clearly said, extend in the U.S., file Portugal first, take the credit in the U.S. after that. Now I'm hearing file in if we're talking about U.S. sourced income here. So now I'm completely confused and I don't know who to believe.
You're not alone in that. This does happen with how things fall. Alan, what do you have to say to that?
Well, I've kind of come up with some similar situations like this, specifically for people in the UK, because they have a different tax year. Their tax year goes from April 6th of 1 year all the way to April 5th of another year. I don't know why they do that, but that causes a lot of problems. So there's also the issue of, where all your income is. Remember, wherever that income comes from or sourced is typically the country that has the first right to tax. So you might have some income coming from the United States. You might also have income coming from Portugal. None? Okay, well, that does help simplify it. I'm not exactly sure why the Portuguese accountant would give that advice. It doesn't seem to follow the general guidelines. Again, there might be something Portugal specific, but how can you claim that credit, on your Portugal return? So just remember too, you can always amend your U.S. tax return if something comes up. I'm sure you could probably also amend your Portuguese tax return if something came up. For example, you wind up having to pay more tax later on down the road in the U.S. and you want to use that as a credit. So
I don't want to leave. I don't want to leave disinformation out there, so you may have solved it inadvertently. He was talking about the fact that the tax years don't match up, that Portugal starts in April and goes to June, and obviously April is the dead. So he said automatically extend in the United States, file Portugal, and then file your US. Is that how you would proceed?
Yes. When is the Portuguese tax year? Is it like a July 1st to June 30th?
I thought he said April to June is filing season.
Go on, Jerry.
If I may just jump in, the tax year is the calendar year, January to December, but there is a filing season which I think runs through to April of the following year.
Actually, Jerry, the tax filing is April 1st through June 30th, and then the IRS doesn't complete your return and return it until August. They start August 1st. So that's what's going on here in Portugal, and that's why you do want to do the 6-month extension. You do want to pay your U.S. taxes by April 15th to avoid penalties, but you do want to get a 6-month extension.
Good tactic there. Thanks, Trevor. Thank you on that. And a little bit more of an insight into how the two systems work together. Now, in the event of, which I think is probably almost certain tonight, of us being overwhelmed with questions, do continue the conversation on the forum, because you'll get some other input from people who have personal experience from this community over on the forum. So don't forget that's available to you. And of course, we're going to ask Alan back, because this has been a very important and useful webinar tonight. Let's see how many more we can get through in the remaining time. Dream Team coming up at 9. I'm going to cherry pick these now because there are so many, and try and go for more general questions. And then when I stop the recording, we'll come back to some of the more personal ones if you feel like your question hasn't been answered. If I'm not moving to Portugal just yet, but would like to work with Greenback to do my taxes while still in the United States, is that a possibility there, Alan?
Oh, absolutely. You don't have to be an expat. In fact, we do returns for people who are, in that case, who are expatriating or people who are repatriating. And we also do returns for people who aren't U.S. citizens but are in the United States working and earning a living. So,
all right, that's wonderful. Yes, good news. And same link, of course, to get in touch with Greenback. Tamara, good question here. Do you need to report something like an FX account? Of course, if people are working with Spartan or Wise, if they're holding dollars for a short time as a transfer vehicle, does that need to be put on the FBAR?
Oh, well, with money transfer services like Wise and OFX, and even wire transfers, most people don't realize it, but you transfer from one country to another country, and it looks like it's just going from OFX or Wise directly. But whether it's a wire transfer or money service, usually there's another bank involved. And specifically with Wise, they have another account, and it's just to move money in and out. It's called
holding account or something like that.
Yeah, contra account, Costa account, actually. You don't have any control over it. It's just there to facilitate some movements. Most people don't even know it's there. So no, you don't have to report that one. There is a specific exception for that type of account. But if there's anything else you're not sure of, remember there's no extra fees or penalties or taxes for reporting more than you have to. But if you don't report enough, you could be penalized. So when in doubt, just report it and be done with it.
Okay, Barbara, thanks for that, Alan. Wait, what? Hang on. I have a US income pension, that is. Portugal is going to tax me on that. it is not foreign earned income, but I owe Portugal tax on it. Can I get a credit for the tax I paid to Portugal towards my US tax requirement?
Um, well,
That
again, it should work to where it's US sourced income. It's not earned income, so salary, wages, or anything. So foreign earned income exclusion doesn't apply. So you might be able to get that tax credit in Portugal. So it's sourced in the United States or comes from the United States, that pension. They have the first right to tax, right? So you file and pay your US taxes. You file your Portuguese taxes and you reduce the amount of Portuguese tax you owe, or you should be able to do that. Reduce the amount of Portuguese tax that you pay based on the US tax.
Okay. All right. Alex, can you please repeat what you said about the excess taxes paid, where the difference, the overpayment of sort versus the other country, can be used over 10 years? Can you repeat that part?
Oh, yeah. Yeah, absolutely. So, let's say you pay $12,000 in Portuguese tax, right? And your US tax bill is only $10,000, right? So you pay Portugal 12, right? You reduce your 10,000 US tax bill to 0, right? So 12 and then 10. What about that other 2 that you weren't able to use? That is the foreign tax credit carry forward that you can use for up to 10 years in the future for any foreign earned income.
Great. Thanks, Alan. Right. In the last couple of minutes then of the recording, let's see if we can help S and Gilbert. S, do you want to unmute and ask us your question?
Yes, hi. I wanted to know if you own, I have an online business that is registered in California. It's not with the business office, it's just like a DBA. If I wanted to cut ties with California, how would I go about that? Could I register it in another state, or would I need to register it in Portugal, or what?
Oh, well, you could do either, but there's some different consequences between the both. Okay. So if you want to cut ties with California, I would say absolutely get rid of that California LLC. So maybe the best way to do that would be to open up an LLC in another state, maybe Nevada, Wyoming, etc., first, and then do that book transfer of everything over to that new LLC, then officially terminate that LLC in California. Okay. You could do that.
It's just a DBA. It's not an LLC.
Okay. Are you working? Is it like a limited liability company? Something that's
No,
registered?
it's like I have an Etsy shop, and just to do business, I needed to have a doing business as. I didn't necessarily have to have an LLC. I mean, that might be something that I do in the
Okay.
future,
So
but it's
you didn't register this company with the Secretary of State of California or any other
no.
states. Okay, so then you're working as a sole proprietor.
Right.
So that doesn't connect you closer to California. Okay.
You said it
Just
doesn't connect me?
That's correct. Right. As long, what would connect you is if you're physically there. Or if
No, it's just like the business address is in California though. Like that's on the account.
Yeah, I mean,
I don't actually live at that address, but it's
I wouldn't worry about that so much unless you had property there in California, unless unless you spent a lot of time in California. I wouldn't worry.
Stay with us. Thank you for that,
Thank
Alan.
you.
Stay with us, yeah, because we can allow some more time after the end of the recording. But I want to get to Gilbert as well, who's been very patient. Gilbert, go ahead.
Oh, can you hear me?
Yes, we
Yes.
can, loud and clear.
Okay,
How you doing, Gilbert?
see me too. Good. All right. My question is, if you have NHR status, what do you owe to the government of Portugal from Social Security income in the United States and the retirement income that you're paying taxes for in the United States?
Well, I'm sorry, I can't really answer that one too accurately. I can only just sort of guess because
Okay,
I don't know enough
you can
about
guess better
Portuguese
than
tax.
me.
I mean, I think
That's a
maybe
good
there's
point, Gilbert. But I should add the reason for that is, of course, because Alan is working for Greenback Expat Tax Services US side, and we have different professionals who help you out with Portuguese taxes and the NHR over here, Gilbert. But what do you want to say about that, Alan?
Oh, Yeah, I was just gonna say I'm not really sure, but maybe there's other people out there in the audience
I
who have
agree.
these
And again, a
NHRs and they can
forum, yeah,
chime in.
something we can take to the forum, and certainly bear in mind for future webinars as well. So we're not avoiding the question, Gilbert. It's just that this isn't exactly the right environment for that.
Gilbert, I did some research on that, and so I can answer it. I'll take it offline.
Yes, let's pause the recording first before we do that. But thank you, Mark, and thank you everybody who's doing a lot of work behind the scenes, including Shari and other people helping each other out. Wonderful community effort going on behind the scenes. Jerry, I think you might want to add something before we pause the recording.
Well, I'm just really responding to Gilbert. If you contact me, you can see an email there. I can connect you with our Portuguese tax advisors, and they can answer all those questions for you.
Okay.
Okay.
Admin at
See
Expats.
my email address below my my name there. Just drop us an email and I'll deal with it. Okay.
Right. Great job, Alan. Thanks, Jerry. Thank you, Gilbert. Thanks, everybody, for your questions. And I know we've been officially overwhelmed. We're going to pause and see how many more we can get to now. Alan, Shari, great job. Thank you for being here this evening.
Okay, thank you, everyone. I hope this helped.